please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But first, let's get you the market action of the day, where we saw expiry jitters leading to bears dominating the bulls convincingly. The Nifty ended the day below the 10,600 mark, losing 3/4% in the process. The Sensex barely managed to hold on to that 35,000 mark. Banks recovered in the last hour, yes, to slightly outperform the benchmark indices, but mid-caps were routed, and that index saw the brutal sell-off to slide more than 30 points. There's a sea of red across the board. Anuj Singhal is here with a wrap of today's market action. Anuj, it has been a series to forget for the bulls. You know, we saw bulls and bears seesawing for some time, and then finally bears seemed to emerge the winners.
Well, what a series it's been. An expiry day was where the bears really went hammer and tongs, especially on the mid caps. There was a carnage out there. In fact, the Nifty and the Bank Nifty would have fallen more if not for that 3 p.m. move on the HDFC Bank stock. But even that didn't prevent the market from a big decline. The Nifty was down 8%, the Bank Nifty down 0.4%. Advanced decline was at 1:3. Mid caps have been under pressure. More than 400 stocks have hit fresh 52-week lows on the BSE, and even good quality mid caps are now under severe pressure. Among index stocks, the big losers today were stocks like Tech Mahindra, HPCL, and Titan. But the big drag came from stocks like Tata Motors, ICICI Bank, Reliance. UPL was down, and so was Yes Bank. On the gaining side, Infosys and M made a move, and HDFC Bank had late move at 3 p.m. Non-index side, big losers: MRPL, Jet Airways, NCC, Shriram Transport, IGL, Ashok Leyland. So even the good quality stocks have started to correct, and correct quite a bit. All in all, it's a series which the bulls would want to forget. And I'm not even talking about the Nifty and the Bank Nifty. The mid caps and small caps is where there's been a complete hammering. Let's see if the capitulation is done or not. We'll find out, of course, in the July series.
Okay, a humbling day as far as the equity markets are concerned. But let's talk about the big global story, which has a ripple effect back home as well. A day after White House asked its allies to stop importing crude from Iran by November, sources in India's oil ministry tell CNBC TV18 that they haven't received any official communication in this regard. Remember, India imports about 400 to 500,000 barrels of crude from Iran per day. Anshu Sharma has been tracking this story from day one, and she's here with the details. Anshu, you know, this is a complex issue. Tell us, what are your sources telling you as to what the oil ministry is planning?
That's right. We understand from our government sources that any decision with regards to Iran sanction by US will have to be taken up through the diplomatic channel, and there's not been any written communication between US and India so far. Remember, US has warned China and India to cut its crude supply from Iran by November. We also understand that India is heavily dependent on Iran in terms of crude supply, as Iran is the third largest supplier. Just last financial year, we imported about 22 million tons of crude, and in the previous financial year, FY17, 27 million ton of crude was supplied by Iran to India. We also understand that US has started supply of its crude to India, and some negotiations are happening to increase crude supply from US. With rupee weakening and crude prices soaring, Iran sanction and warning from US is definitely a concern on India, especially when India is heavily dependent on import of crude. Back to you.
Absolutely, Anshu. Thanks for joining in with that. Speaking of India and US relationship, the US has postponed the 2+2 dialogue with India. Now, this was much anticipated dialogue between the defense and foreign ministers of both the countries. In a message to India's Ministry of External Affairs, US Secretary of State Mike Pompeo has said that the 2+2 dialogue has been called off or cancelled due to scheduling issues. He clarified that the postponement was prompted by reasons entirely unrelated to the bilateral relationship between the two countries. Let's bring in Ritu Parna Bhuyan, who tracks this story very closely. Ritu, this is the third such postponement of these talks. What are you picking up? One can't help but figure out what exactly is going wrong here.
The 2+2 talks were scheduled to happen on July 6th, but now has been postponed indefinitely. The US Embassy has released a statement in which it has said that this scheduling change was prompted by reasons entirely unrelated to the bilateral relationship. And it goes on to say that the United States remains firmly committed to a strong relationship with India. Let's look at the background of this 2+2 talks that was scheduled on July 6th. Firstly, of course, there are sanctions against Russia, which US has imposed that would have impacted Indian arms procurement from Russia. This was to be raised by India in this 2+2 meet. At the same time, the US Department of State has been saying that any Indian company dealing with Iran or directly or indirectly could face sanctions from US. So this was also supposed to be discussed. And at the same time, though it's not directly related to the 2+2 talks, remember that there is a trade war going on, and India has also imposed retaliatory tariffs against US steel and aluminum duties. There is already a delegation from Washington here discussing trade-related issues. So everyone was looking forward to these 2+2 talks, but as of now, we do not have a new date. According to US Embassy, a new date will be discussed between both the governments, and these 2+2 talks will be scheduled. With that, it's back to you.
All right, Ritu, thanks for joining in with that. Now, meanwhile, US President Donald Trump and his Russian counterpart, Vladimir Putin, may soon meet in Finland's capital, Helsinki. Though the location and date of the meeting are yet to be confirmed, the announcement that the two leaders will meet has been made after a meeting between Putin and US National Secretary Advisor John Bolton. Also talking to media last night, Donald Trump said that Syria and Ukraine will be in focus during his meeting with Putin. Well, back home, and here's a CNBC TV18 exclusive. Sources within the Finance Ministry tell us that the view within certain quarters of the ministry is that there is little merit in the proposal to create an asset reconstruction company. Now, this due to the belief that an ARC may confuse the current strategy to tackle NPAs, while IBC is already taking care of big NPA resolutions and is getting results. However, sources tell us that the government hasn't taken a decision in this matter yet. Now, we are also focusing on rupee this evening. The currency has weakened 8.1% so far this year, making it the worst performing currency in Asia. So today, the rupee fell to an intraday lifetime low of 69.09 versus the dollar, owing to a variety of factors, including a strengthened higher crude oil prices. The rupee had hit its previous all-time intraday low of 68.63 on 24th of November 2016. Let's put in perspective. Lata Venkatesh is joining in to help us understand the day's currency movement. Clearly, a lot of factors that are affecting this, but how do you see this playing out in the days to come?
Well, in the first place, we are very sensitive to crude. So crude rising 3% today, and in fact, maybe almost 6% this week, was clearly a rupee negative, increases the current account deficit and hence pressure on currency. But it's not alone. There has been a synchronized fall in emerging markets, equities and currency. The yuan has been depreciating, and even to compete, the Indian rupee's slide is good. And I wanted to emphasize that this is a good slide. It's not something that's spreading mayhem and panic. It's happening gently, and it's happening competing with other emerging markets with whom we compete on trade terms. Now, one reason why the EM currencies are falling, especially yuan, could also be that their own central banks are allowing it to fall. Aside from the trade tariff tangles that are putting pressure on the Chinese economy, after all, the Shanghai index also is down in bear market terrain, down 20% this year. The emerging market central banks would like their currencies to fall to make up for the higher tariffs that the countries are facing. It neutralizes the higher tariffs to some extent. So this could also be a fall which is welcomed by the central banks, and therefore they're not fighting it. Again, for India itself, it's not just the crude fall. It's also that foreign funds have been deserting Indian markets for some time now. And now you feel the pinch because you're also paying a higher import bill for crude. Sentiment also is against the rupee. But 69 is not a long way from that 68.80 that was yesterday and the 68.60 the day before. So it's been a gentle fall. Importantly, we should note that while rupee may be the worst performing 8% fall in 2018, it compares to like 7.5% for the Indonesian rupiah or around 7% for the Filipino peso. So we are not singled out. And if you compare us to the ruble, the rial, the Turkish lira, some of them have fallen between 15 and 20% in 2018 itself. That's the 2018 comparison. If you take the 5-year comparison from the taper tantrum onwards, the rupee has been flat if you compare it to August of 2013, we are flat. Whereas most other currencies, the ruble, for instance, has depreciated by 100%. The Brazilian real, the Turkish lira, all of them 160, 180%. So actually the rupee is a picture of stability, and this weakness is something that perhaps is merited by the macros of the country. But is this a good fall? What will it do to the economy? And is there more to come? We have a couple of experts joining us. Sajid Chinoy, the chief economist at JP Morgan, is with us, and Alvin Tan, the currency expert from SocGen, has also joined us. Gentlemen, thank you very much for joining me. Well, first, Sajid, before I come to the macroeconomic impact, let me ask Alvin, rupee is only a tad underperforming other emerging market currencies. Would you worry that this could be become a little manic at all, Alan?
Yes, of course, there's always that worry, but I do share the sentiment that...
Thank you very much for joining me. Well, first, Sajid, before I come to the macroeconomic impact, let me ask Alvin, rupee is only a tad underperforming other emerging market currencies. Would you worry that this could be become a little manic at all, Alan?
Yes, of course, there's always that worry, but I do share the sentiment that the rupee decline is not particular to India, certainly. There's a bigger global macro move here in the dollar among emerging market currencies. So if it does get a bit more manic, as you say, it will be due to these global factors rather than Indian-specific factors.
Yep. Okay. Well, let me get a similar reaction from Sajid Chinoy as well. Sajid, is this worrisome or is it welcome?
Well, it's a bit of both, Lata. I mean, just understand the larger global backdrop here. We've had a dollar that strengthened almost 7% in the last 6 weeks, number one, both because of desynchronized global growth and because of fears of a trade war. All emerging markets have come under some pressure. I would argue India is much more fortified than many other emerging markets, as well as 2013. But what's interesting is in the last 10 days, something different has happened. First, you had the emerging market current account deficit countries come under pressure. Argentina, Turkey, South Africa, Brazil. The last 10 days, it's been predominantly Asia. Right? 6 of the worst performing currencies against the dollar in the last 10 days are Asian. So this is very much reflecting the regional fallout from a tariff war between China and the US. I think that's the backdrop here, number one. Number two, we've seen that China's growth has slowed into mid-year. That, compounded with concerns of a trade war, have caused Chinese policymakers to consciously ease policy. You had a reserve requirement cut over the weekend and some currency weakness. Now that's the context here. If the dollar is strengthening and the CNY is depreciating, every other Asian country will want to follow suit, and therefore central banks have been permissive of this. In India's case, I think this is very much calibrated, no panic. We're in the middle of the pack. We've done better in the last 10 days than most current account surplus countries in the region, so there's no fear here. But the concern is that if the dollar keeps strengthening and CNY continues to weaken and there's some capital flight out of China, then what is a calibrated move could potentially become disruptive.
Alvin Tan, will that happen? The scenario that Sajid is drawing out, continued strengthening of the US dollar and depreciation of the yuan.
Well, I think what's quite interesting, we're talking about the last several days, is that the DXY index, which is the broad dollar index against major currencies, actually fell between last Thursday through this Monday. This is when euro dollar bounced from 115 to 117, if you remember. Yeah. And interestingly, in that time period, the dollar CNY was actually going higher. So indeed, there is some evidence that Chinese authorities might be using depreciation as a policy tool to counter this escalating trade tensions with the United States. And indeed, if this were to continue, it could see a return of what we saw in 2015, 2016, when Chinese depreciation actually shifted expectations among Chinese investors, prompting them to move money out of China. So that is indeed the danger going forward.
Let me persist with this central bank issues and then come to Sajid on the Indian impact. The Indian central banker Urjit Patel had also raised in Financial Times, in a Financial Times article, the possibility that the Fed unwinding its balance sheet or shrinking its balance sheet at a time when the US fiscal deficit is rising could demand that more dollars come into US bonds and therefore an outflow from emerging market currencies. Separately, if you're saying that the Chinese depreciation could become a flood like one saw in Jan 2016, first of all, what are the chances of that happening?
Okay, I'll take that question. I think, first of all, what is different between now and 2016 in China is certainly that they have tightened up the capital account situation. So there are a lot more restrictions now. So that's the first thing to note. But the chances, I think, of that risk is high. It's from a combination of trade tensions escalating, number one, and also it's also worth mentioning that Chinese equities have suffered quite significantly since January. I mean, Shanghai equity indices are down about 20% since their January highs. So separately from what's happening in the currency market, Chinese investor sentiment has clearly been shaken in the equity market. Now, what is holding up Chinese assets at this time are property prices, which are still generally quite well supported. But if that were to go, and in tandem with further depreciation of the renminbi, that could indeed spark another capital exodus out of China, notwithstanding the stronger capital controls they have now.
So that's not your base case. You don't expect a manic Chinese depreciation and emerging market or Indian currency depreciation? What would be the odds for that at all? Alvin?
Yes, that's not our base case. I think the odds of that are not insignificant. I would place them at approximately 20–30%. Basically, I think the big question mark in the next week or so is whether the US will go ahead with the imposition of tariffs on the targeted 50 billion of Chinese imports. That decision is supposedly coming next week, July the 6th. Of course, before that, tomorrow, we will hear from the US Treasury Department on what kind of investment restrictions they will be placing on China. So that's the near-term issue. We continue to think that the Trump administration will be seeking some sort of broad agreement on trade rather than see an escalation of the outright trade war.
Okay. Well, Sajid, now to come to you. What does 69 on the rupee mean at all? Are you seeing a worsening of current account deficit, fiscal deficit, inflation?
Look, I'll just first say that I don't think it's very meaningful to look at the bilateral rupee dollar rate. And, those are going to make new highs because India's inflation is higher than other countries. I think the right measure here is to look at the trade-weighted rate. And what you'll see is India had a 20% real appreciation between 2014 and 2017. In 2018, about 7% of that has reversed. So in fact, the rupee is stronger now than 4 years ago. And therefore, some calibrated trade-weighted depreciation is not a bad thing for this economy, for the underlying competitiveness, number one. Number two, I think we're much more fortified than 2013. Macro fundamentals are better. The twin deficits are still higher than last year, but nowhere near where they were in 2013. And we've got significantly higher buffers. The central bank's got reserves. The reserve cover is 1.5 times that of 2013, and the RBI seems able and willing to use it. So no reason for any panic. This is a global move. India is in the middle of the pack. Where are the vulnerabilities? I would argue it's on the current account. If oil is going to be creeping towards $80 a barrel, the current account for this year will be closer to 3% of GDP, about $80 billion. How does one finance that, especially if you're seeing portfolio outflows from all emerging markets? That's one challenge. I think ensuring we stick to our fiscal target so that there's no more pressure on the bond market later in the year is also something we need to be very particular about. So yes, are there pressure points? There always are. But I think compared to 2013, we're much more fortified. And today, India is still regarded as one of those emerging markets which are much more, in a better position to handle global stress than many of our other peers.
Okay, well, Alvin Tan, if you can just leave me with a range and an average of the dollar rupee for 2018.
Well, actually, over the next 3 to 6 months, we are expecting dollar rupee to move up above 70. So we're looking for dollar rupee indeed at 70 in the first quarter of next year.
Okay.
But I echo the sentiment that that move itself is not problematic.
Fair point. Sajid, 70?
Oh, Lata, this will depend entirely on the dollar. If the dollar were to strengthen 4-5% from here, all EMs are going to come under pressure. So there's no sacrosanct number.
Sure.
Conversely, if the trade war doesn't materialize and the dollar weakens, the rupee could go the other way. So I think any bilateral, rupee-dollar number, ad hoc number, I think is not meaningful, given that central banks look at the trade-weighted exchange rate.
Fair point. Gentlemen, thank you very much for joining me. So, a perfect storm if the US administration were to persist with the restrictions on Chinese investment, with that $50 billion packet of tariffs, and if the dollar were to rise. But that perfect storm may not happen. Political systems and political economies are usually dynamic and could diffuse that crisis. But at least in India, the expert view is that this is really not worry time.
Okay, that's a good note to take a quick break. We will take a very short break, but remember, news and updates will continue on the other side. Don't go anywhere.